You might be a little bit disappointed because finance people are very simple. They don't require very much science. But I will give you some insight on how we are thinking. And I was a little bit confused about the thing in financial companies. Um, one hand, you have the investors and what they need when they decide on what to do. They want to see that they have return on their investment. If they have an investment opportunity, they will put on resources to do so. And to that, of course, the atlas might be of interest. But also, if you want to have a low cost of, or that they don't require a very high return, so more a kind of a low cost infrastructure, then the risk has to be low. And if the risk is not low, or perceived to be low, they will ask for a high return. And if they don't see that, they will not do it. So that's the simple world of the investors. And they can be quite sophisticated and they can get a lot of capacities in to make sure that they understand these things. Banks are also very simple. Uh, we really only care about the cash flow and the security of that cash flow, that we are certain that we get the loan back with our interest, as I said before. But of course, there is a lot behind to be certain that we do get the money. And that's, I guess, where the crook of the matter is. And we are very much concerned about the risk and the mitigations to those risks. And that's where the solid work of the operators and all the due diligence, and also I probably can't stress enough that you have the ones giving the concessions, that they have done the proper work, so that they only give away concessions which we rely on, which is proper. So you're done with your two seals or triple seals or five seals, that you don't have any major faults, and that they do understand the pressure regimes, that they have to do their job. We rely on that. So if we have in an area where we don't really know the competent authority, we get very sketchy and we probably will not go in there because we don't understand or we are not confident that they haven't screwed it up. Sorry for the language. So back a little bit to this kind of overview we have on the long term, the big picture, and I will address the big picture later on. The one where the regulator has to do in the middle here, and where we as a finance people, finance institutions, we are looking at really cash flow and near term. And we would like to have more than 10 years, Daniel. We would like to have 15 easily because then you can lend more money. We are very easy. We are looking at the net present value, and the net present value is higher the more money you put in there, so the longer term. So you can imagine that if you have a 10 years profile, you can perhaps lend 60% of the investments. But if it was a 15-year profile, perhaps that amount will increase to 80%, depending on, of course, how good the project is and the net present, the cash flow of that. But it is the shorter, the less money of banks, so more equity and more difficult to get a return. Um, Perhaps I can also say on this picture here, which I haven't really prepared a separate slide on. When banks look or financial institutions look at where to invest, they often have two ways of approaching it. Some banks are product driven, so they are looking for products or projects which or a situation where their products fit. And I don't really care so much what kind of company they are approaching. They want to sell their product. So the product could be project finance, could be a bond. So if they are selling investment bonds, they're looking for all kind of investment grade companies and try to put in their bonds capabilities in there. Other type of banks, they are much more concerned about the clients, the customer, and try to service that customer the best they can. And then they have a suite of products to help them. DNB is one of those type of traditional banks where we actually have, well, yeah, I guess both types is traditional, but we are focusing more on the customers and we see what are their needs. That's one of the reasons why I'm into the CCS space. We try to understand their needs before they come to the investment point, so that when they are closer to decisions and they want to talk about money, we are actually capable of having a good dialogue with them. If you have a pure project finance kind of bank, then you put the project finance template over the project, and you get the results. And that template is pretty comprehensive, and it can cover almost everything. And then what they don't know, they buy a due diligence report. So when it comes to then how relevant is the EU kind of the new map you're constructing for us as DNB and probably a number of other banks similar to us, we are more looking at where are our clients, and we are considered the North Sea as our kind of relevant area. That's where we have our clients. So we are not that much concerned about what's happening in the eastern part of Europe and the southern part of Europe, unless some of our existing clients go that way. And if they go that way and they ask us to come along, we will do that. But we'd like to see those maps to understand that the competent authority of the country actually knows what they're doing. And we do have skills in-house to understand if there are big holes, not the smaller, more details, but the big holes. And if we see big holes, we get very afraid of what's going to happen. I'll skip this one, but go more into the way we are looking at it, which is perhaps a bit to the point that not everything on the storage side is quite clear from day one. You will have some contracts with emitters, which is not filling up the full storage, but you might perhaps start with 4 or 5, but to fill it up, you might need 10. And some of these emitters will over time kind of go bankrupt or will disappear. So we are thinking about a way to solve it, different from the pure project finance scheme, is to make a borrowing base. So you take the contracts with core emitters, core kind of supporter of the scheme, and see how much money you can borrow against that cash flow. And then we add on as the project develops. Of course, if you have too few emitters in the start, the loan is so little that it's not really valuable. But that kind of optimization of the project itself. But this scheme kind of will help the operators and the investors in that to kind of maximize the debt and thereby reducing their equity and or at least optimizing their return on their investments. And to understand that, the kind of the cost and the risks and the capex and all that, we really need to understand everything which has been talked about. But we rely on the operators giving us the data, the regulators kind of accepting it as a good thing. So there are a lot of holes in the one which has been done recently with the NEP and the HyNet, but at least we trust the system between the operators and the UK state to be sensible, which they have proven in a long time with the regulated asset value in other areas. When they come up a new issue, they will solve it in a practical and sensible way. And that's the risk we can take. At least the risk we do take. It was a big discussion in our credit committee if that was really a risk we want with the UK government. But we decided that's okay for us. But we do also have to have some other things, and I will come back to the SPES and SMRS and so. I will save some of the more issues we have identified to a separate slide later on, where I think we can save a lot of cost if we are willing to kind of revisit some of the statements we have out there or expectations. Some of the things we kind of do really look into is, do the operator have the required skills and experience? It's important for us. Of course, it's quite easy with the big names being done with oil and gas for a long time. At least the one we don't view as cowboys. There is a lot of things to be understood, and particularly also to be the multi-phase flow downhole if you start with gas and go into the liquid flow and supercritical. So we need to understand this, and I think logistics is actually also a big issue when you take your ships or pipelines with the CO2, and also the CO2 quality and the handling. So we are concerned about this, and we do study it to see that this risk is mitigated. We kind of mitigate it by us not owning that risk. It's the operated or the contingencies or some other ways of kind of structuring it or putting it back to the state. But we as a bank doesn't want to own those risks. We do realize that we have to take some. So we do, for example, say that, yeah, fine, we will understand that the development risk is something we can do if the company is good. We think the 20-30% contingency is sufficient. And cross our fingers and hope they have the A team on. If they put on the C team, it's going to go bad. And then we are very much looking into all these points, perhaps which has been mentioned about the inactivity rates, the pressure controls, the valves, redundancies, the intermittencies, these things. We also even try to contribute on a research project together with Bellona and other interests, where we are asked for a project to be accepted to understand how the pressure interference in a big aquifer system interfere with the next project. So we are interested in these things. But the one way to us to then fix on the storage is really to analyze it, and we focus on what's called the P90 or the proven reserves. In that, we rely on the company and third-party companies like the ERCE, SPT. It's a number of those which can do these things. It's much less than what the company typically will plan for. They will typically plan for P50. We will only accept the P90, but that's fine. So in our simple world, we put up a risk matrix, which we then have to, if we have things up in the red, so being the high risk, the high probability, then we have to do something with the finance structure to put it down into the yellow or the green. It's green. Sometimes it's an inherent risk, and all the companies, they have a much more comprehensive and better kind of matrices than this. But they also have to communicate to the decision makers, which are even far further removed from technology than what I am. But you can recognize a number of these topics which has been discussed over the last few days. Uh, we don't really have any very specific difficult ones, apart from perhaps which you may not kind of recognize. The biggest risk we see in projects or in banking is that the contracts you have doesn't exist. The people walk away from them and they say, sue me. That's typically where we lose money. And you can then go to the courts and have it for 4 or 5 years, and there will be losing money. Um, so we do these things, which is kind of similar to what has been addressed, but on a higher level. And we expect a lot of this to be picked up in the SPE, SMRS studies, where hopefully, when we're picking the right consultants to do it, they will actually cover all these areas, and they will reduce the volume available for injection as well as long-term storage based on the evidence. We believe that the system we have with the borrowing base, when you have more information, that will grow, possibly, most likely. And then you can then add on volume or add on capacity, add on more contracts. So yes, we do need a comprehensive due diligence report from different topics. As time goes on, I think we have to go less and less deep in these things. But I promised one kind of slide for 6 areas where I think we can actually save a lot of cost by kind of reconsidering some of the points. The state is taking over the storage at one point. Why can't they take it over after 1 year instead of 20 years? If it's proven safe, if you have the system and you have the qualification that it is safe, and you have probably 20, 30 years to understand the dynamics, why do you need another 20 years? For what? To see that gravity works? I guess it will do. You might have pressure kind of differentials, but you probably know that over the first 30 years. You don't need the other 20 years for doing that. So I think it is an area where we really could save a lot of money, because it's me as a kind of consumer, which end of the day will pay for the product, which is going inflated up. And I don't see it really adds any real value. It was a directive written in 2009 through a kind of political process in Europe long before there was any practical use of CCS, and the Germans, they had prohibited the storage. So I think there are reasons why we should revisit some of them and do the omnibus approach to see where can we take down cost without really making any real difficulties. And also in terms of the leakage of the CO2, in the case of a leakage and the CO2, for me, that's not an environmental thing. That penalty is a financial penalty. You can probably penalize them differently instead of putting up all that upfront cost. They cost a lot. In one estimate we had, and this is case specific, we estimated by having all these upfront in the most cost safe or ideal situation for some communities, the lending capacity dropped 25% compared to just facing it over the sensible time. That without even taking it away. So that's a point two, and point three is the new one. The do no significant harm. We run into some problems there in that it was introduced the 1st of January. In terms of the infrastructure rebate, they require that it's also kind of these 5 points has been addressed. Most people haven't really addressed that, and it's recently introduced. Why not just wiping away? And we're back to the situation in December. Doesn't cost anyone any money. We do have more. It will reduce the capital the banks needs to have behind the project, a green project. It's still qualified with all the kind of main contribution aspects of the climate, and then it will save perhaps half a basis point, no, 50 basis points of a margin. Could be for a big project, could save $400 or $500 million over the life of the field. Easy to do. It's just paper. Doesn't cost anyone money. It's only paperwork. And then you do financial security. Be prudent. Be risk-based. No, it's kind of blown up with all kind of non-quantified risks which they believe that may be. Why should the well have a blowout of CO2 for 3 months before it's closed in? And what kind of risk is that? And how much is it? Why should you pay for that CO2 coming out when it blows up the cost of the CO2 storage? The penalty should be another place. And also, if we are still having all these things, what about having a sinking fund which works across a number of storage sites and cross-border? Mm-hmm. Why is that such a difficult thing? There is a lot of kind of, and believe it's a lot of risk fair. Nobody really dives into it, and nobody really dare to kind of move it. It's about like if we have a HSE thing in the bank or whatever. Oh, it's safety. Everybody shuts up, and we just do it, regardless of the cost. I think we have something about the same here. And the last one is to, when we have a contract, things are done, make sure that the government in place are not fiddling with the data, fiddling with the contract. The UK has realized that, using a kind of commercial vehicle in between, because they know the politicians can't keep their fingers off. Politicians know that as well, so they're happy having that construct. There is discussions other places. I shouldn't name Denmark, but they are considering having some kind of leeway that the third-party access should be in there, and they can open contracts. If that's a possibility, we will discount that 100%, perhaps 110%, because there will be legal issues as well, which we have to recoup. We are not blind, we are not stupid to risk, and we will protect ourselves. We will structure it so that we are not taking that risk.